Welcome back to Investing Talk podcast. Today we're digging into the source material you sent over on Nebius Group NV. It's certainly one of the most talked about names in AI infrastructure lately. Our job here is to sift through all these analyst notes, the articles, the company research you've gathered, and tackle that really key question. Is Nebius Group actually a good buy right now? We'll pull out the hard data points, look at the big shifts happening within the company, and also make sure we cover the major risks involved. But before we dive in, just a quick reminder, please hit subscribe, like this discussion if you find it helpful, and definitely leave us a comment. And hey, if there's a specific company you want us to look into next time, just drop the name or ticker below. We do read those. Okay, so let's get started with the fundamental story. The buzz around Nebius Group is pretty intense. Looking at the sources, it seems like the growth numbers are, well, pretty eye-watering. What are we seeing?
Yeah, eye-watering is a good word for it. Nebius Group hasn't just grown. It's more like they've exploded onto the AI infrastructure scene. If you look at the top line, their full year 2025 revenue came in at $580.17 million, which is solid, sure.
Right.
But the real story is the year-over-year comparison. That's what's fueling a lot of this bullish sentiment.
And that $580 million, that's a 393.76% jump from 2024's $117.50 million, right? I mean, nearly quadrupling revenue in a year.
Exactly. In almost any industry, that kind of leap is a massive signal. It speaks to serious market capture and execution.
Okay, so huge historical growth. What about looking forward? Does the momentum keep up?
Well, according to the analysts cited in the material, yes. They're forecasting 2026 revenue hitting $1.62 billion.
Wow, okay.
Which, if they hit it, would be another 178.54% increase on top of the huge 2025 number.
So they'd be moving from like a fast-growing niche player to potentially a real leader in the space?
That seems to be the expectation baked into those forecasts, yeah.
Now, that kind of explosive revenue growth, it often burns a lot of cash. But the sources suggest Nebius is actually improving its bottom line, even if it's not profitable yet.
That's right. And that's a key point. While the earnings per share, the EPS, is still negative, it's improving dramatically. It went from negative $2.28 back in 2024 to negative $0.35 for 2025.
Okay, much closer to break even. What does that signal?
It signals operational leverage. Basically, they're getting more efficient. Their costs aren't scaling up as fast as their revenue is.
Right, the infrastructure costs are being spread over more sales.
Exactly. That's a really important milestone for these hyper-growth tech companies. It shows the model can work economically.
And didn't we see some confirmation of that in their Q2 results from August?
We did. The Q2 numbers were strong. Revenue was $105.1 million, which was up 625% year-over-year for that quarter.
625%.
Yeah. And maybe more importantly, they achieved positive adjusted EBITDA ahead of their own schedule.
Okay. Getting into positive territory on EBITDA earlier than expected is always a good sign. Shows discipline.
It does. And it clearly gave management confidence because they then raised their guidance quite significantly.
What guidance was that specifically?
They raised their forecast for annualized run rate revenue, or ARR, for the end of 2025. That's basically projecting forward based on current contracts. The new range is $900 million to $1.1 billion ARR by year-end 2025.
Got it. So the fundamental picture is one of, well, explosive growth and improving efficiency, but markets need to believe this growth is sustainable. What's the strategic advantage here? The moat, as they say.
The moat, according to the sources, seems to be built on a couple of things: execution capacity and tech density.
Tech density, meaning?
Meaning it's not just about having lots of GPUs. Their innovation seems to be around proprietary tech, like liquid-cooled high-density server racks. This apparently lets them deliver better performance per watt, which is crucial for heavy AI workloads, making them a sort of preferred partner for that kind of intense computing.
And that focus on a high-density infrastructure, that seems to have led directly to the biggest catalyst for the stock recently, didn't it? The September announcement.
Absolutely. We're talking about the Microsoft contract. This was huge validation.
Okay, let's unpack that. How big was it?
It's a $17.4 billion deal, long-term. And it's specifically for dedicated GPU infrastructure.
17.4 billion.
Billion, yes. This wasn't some small pilot program. This really cemented their position, you could argue.
How does a deal that size change the perception? Does it make them seem more like a utility almost?
Yeah.
Essential infrastructure?
That's a good way to put it. It provides massive cash flow visibility for years ahead. It probably removes a lot of investor doubt about whether they could land these huge enterprise-level clients. It shifts them from maybe being seen as a high potential but still somewhat speculative startup to a core infrastructure partner for one of the world's biggest tech companies.
Huge validation indeed. And the market reaction was immediate, right? The stock surged.
Oh yeah, a 53% jump in the share price. And analysts scrambled to update their models.
Materially raising earnings estimates and price targets, I saw. Like Northland Securities bumping their target way up to $206 and calling it a top pick.
Exactly. And that positive view is pretty widespread. The consensus seems to be building. The sources mention 4 analysts rating Nebius Group a strong buy,
And the average price target.
sitting at $105.05, according to the material we reviewed.
Okay, $105.05 average target. Now, before we get carried away with targets, the sources also flag a pretty significant issue, almost like the elephant in the room regarding their financials.
Yes, and this is absolutely crucial for anyone considering this stock. It's the biggest asterisk, you might say. The issue is the lack of key, verifiable financial filings, specifically the standard 10K annual report or the 10Q quarterly reports available through the SEC's DGR system.
Okay, wait. Those are the standard official reports for public companies, aren't they? What does it mean if they're missing?
It means that getting independently verified details on their balance sheet health is difficult right now. Things like specific liquidity ratios, debt levels, free cash flow numbers, even details on insider stock transactions. That information isn't readily available from the usual official sources.
So while the revenue growth numbers are coming from company announcements,
Right, the underlying financial structure, the stability, it's harder to independently confirm without those standard filings. And that naturally increases the risk profile, especially for a company scaling this quickly.
that's a really important counterpoint, a big risk factor to weigh. Yet despite that lack of official filings, management seems to be projecting a lot of confidence about execution, right? They're making big expansion plans.
They are. The sources mentioned management is aiming to secure over 1 gigawatt GW of power capacity by 2026 for their data centers.
1 gigawatt, that sounds like a lot.
It is. To put it in perspective, that's roughly enough electricity to power a medium-sized city. It signals a massive commitment to building out their AI, cloud, and data center footprint. They're clearly aiming to be a major global player.
Okay, so assuming they can manage that execution risk, let's look ahead. What are the key near-term triggers? What's coming up in the next, say, 3 months that could really move the needle on this stock?
The next few months look pretty packed, actually. The biggest confirmed event is definitely the Q3 2025 earnings report, scheduled for October 14th.
What will investors be looking for there?
Continued triple-digit year-over-year growth, obviously. But maybe even more importantly, updated guidance that starts to factor in the initial impact of that huge Microsoft contract. Everyone will be watching that.
Right, the first look post-Microsoft deal, and then there are market structure events too.
Exactly. There are a couple of key index-related dates, a major ETF rebalancing on November 4th, and then an institutional holdings update on December 8th.
How do those impact the stock?
Well, given Nebius Group's rapid rise in market cap and prominence, the expectation is it'll be added to more benchmark indexes. When that happens, index funds and ETFs are basically forced to buy the stock, which can create demand, boost liquidity, and sometimes volatility too.
Okay, so mandated buying potentially. Now, beyond the confirmed news, what about the rumor mill? The market chatter mentioned in the sources.
There seems to be persistent speculation about more big strategic partnerships, potentially following that Microsoft template, maybe with other big U.S. tech firms or possibly Asian tech giants.
Makes sense. Build on the momentum. Anything else?
There's also talk about a potential secondary share offering.
Ah, selling more stock.
Yeah, which normally dilutes existing shareholders so it can be seen negatively in the short term. But on the other hand, they'd likely need significant capital to fund the kind of massive expansion they're undertaking. So it could be a necessary step.
And one more piece of speculation about moving up the value chain.
Right. There are rumors they might unveil their own proprietary AI native cloud solutions, not just the underlying infrastructure.
So competing more directly with the big hyperscalers like AWS or Google Cloud.
Potentially, yes. Instead of just selling the picks and shovels, they'd be offering more complete services built on their specialized hardware. That would be a fundamental shift in their business model and valuation if it happened.
Okay, lots to watch for.
Yeah.
Let's shift gears slightly to the technical picture from the sources. Where does the stock stand right now from a charting perspective?
As of the analysis date, September 25th, 2025, the price was sitting at $51.37, and the short-term momentum looks strong. The stock was up about 15.96% over the prior 2 weeks.
Okay, recent strength. What about key support and resistance levels? Where are the lines in the sand, technically speaking?
Key support was identified at $49.11, so a level where buyers might step in. Resistance, or where selling pressure might increase, was nearby at $53.26.
All right. But the really interesting part of the technical analysis in the sources was the forecast, wasn't it? The projected trading range.
It was definitely aggressive. The forecast suggested a 3-month trading range between $90.74 and $118.23.
Whoa, okay. Compared to the current $51.37 price, that top end of $118, that's like an 85% projected upside within just 3 months.
That's the number cited, yes. An 84.75% projected upside based on that technical forecast model. Pretty substantial.
That is substantial. What are the underlying indicators like moving averages or MACD suggesting? Do they back up that bullish outlook?
Generally, yes. The indicators mentioned, like moving averages, showed a clear uptrend was in place, and the MACD indicator, which tracks momentum, was reportedly showing an active buy signal on the intermediate-term charts. So the technicals seem aligned with capturing further upside, especially around those upcoming catalysts.
Okay, so let's try to pull all this together. We have explosive growth, major strategic validation from Microsoft, but also this significant risk around the missing financial filings alongside a very bullish technical setup. How did the source material score the overall investment thesis?
They assigned it an overall bullish rating of 9 out of 10.
9 out of 10. That's very high conviction. Given how much the stock already ran up after the Microsoft news and that sharp improvement in EPS we talked about, is there a risk that all the good news is already baked into the current price?
That's always the key question, isn't it? The sources seem to suggest that while the announcement of the Microsoft deal is likely priced in, the successful execution of that deal, the actual financial results flowing from it in upcoming quarters, and the potential for further major partnerships, maybe those aren't fully reflected yet. So the 910 rating seems based on that combination. Proven explosive growth meeting major near-term catalysts, all supported by a strong technical trend.
So based on all that, who does this kind of stock setup appeal to most right now? Short-term traders, long-term investors?
The material suggests it could fit both, actually. It seems well-suited for short-term traders looking to play those upcoming catalysts, the Q3 earnings, maybe news on partnership execution. But fundamentally, given the potential market leadership in AI infrastructure, it's arguably best positioned for long-term investors seeking exposure to what looks like a major structural growth trend.
Yeah, that combination does seem compelling. The confirmed massive revenue ramp-up, plus that huge $17.4 billion Microsoft deal, really validating their whole approach.
It's definitely a powerful narrative. But let's leave you, the listener, with this final thought, looping back to that risk factor we discussed. Given the incredible growth story, that 910 bullish rating, and the frankly huge 85% projected upside, how much does that temporary lack of verifiable standard SEC filings really matter to you right now? And how do you personally weigh that specific execution risk scaling up so fast, integrating this massive Microsoft deal against that potential reward? That's the crucial balance you need to strike if you're considering Nebius Group.
That's a great point to ponder. You've got the key insights from the material now to continue your own research and thinking. Thanks for joining us for this look at Nebius Group NV. We hope it was helpful, and we'll catch you on the next analysis.